When you look at commodities right now, relative to the S&P 500, it's at a 50-year low in terms of the relative price ratio. So commodities are cheap. If you believe in mean reversion, you might want to consider taking some profits in areas like stocks and bonds and allocating to some asset classes that have underperformed but historically have done well over time, like commodities. One of the things with commodities is that if you're concerned about higher interest rates, commodities tend to perform well during those time periods. So it's a good diversifier within the portfolio. The other thing that you should be aware of is probably to invest in a broad commodity benchmark, not to try and time it yourself with individual commodities. And our strategy is unique in that it does the heavy lifting for you. It's a good buy and hold approach to commodities. It's broad-based in nature, but the key being, based on a set of rules, it could be long a commodity if it's showing a favorable price trend, and get defensive with a commodity by being in cash if a commodity is showing a downward trend. We track a rules-based index, but unlike some of the broad commodity indices that you're familiar with, like the GSCI or the Bloomberg Commodity Index, which are very good, but they're always 100% long at all times. Now, not all commodities are going to move the same way at any given time. As a result of that, this is a rules-based strategy that looks to be in those commodities when trends are going up, and to be in cash in those commodities when trends are going down. So we could be long anywhere from 0 to 12 commodities and anywhere in between, but it is all predicated on a set of rules. From a diversification standpoint, I believe somebody should have commodity exposure in varying degrees within their portfolio at all times, because you just never know when a bear market in equities might hit and or higher interest rates, i.e. inflation, for example.